Welcome to our CFP exam prep discussion. Today we're diving deep into the efficient market hypothesis, or EMH, a fundamental concept that frequently appears on the CFP exam and often trips up test takers. Let's break down the EMH into its core components. The theory, developed by Eugene Fama, suggests that market prices reflect all available information, making it nearly impossible to consistently outperform the market through stock selection or market timing. The theory comes in three forms. The weak form suggests that all past price information is reflected in current prices. The semi-strong form indicates that all publicly available information is incorporated into prices. The strong form claims that even insider information is reflected in market prices. Many candidates make the mistake of oversimplifying EMH on the exam. They often assume it means markets are always perfectly priced, which isn't accurate. What EMH actually suggests is that prices adjust so quickly to new information that the cost and effort of trying to beat the market typically exceed any potential benefits. Here's a practical example that often appears in exam questions. Imagine a company announces better than expected earnings after market hours. In a completely efficient market, the stock price would adjust instantly to the new information when trading resumes. However, in reality, there might be a brief period where the price adjusts, but according to EMH, this happens so quickly that traders cannot consistently profit from it. A common trap in exam questions involves the relationship between EMH and professional money management. Test takers often incorrectly conclude that EMH suggests professional money management is worthless. The correct interpretation is that while active management can add value through diversification and tax management, consistent market outperformance through security selection is extremely difficult. When studying for the exam, pay special attention to how EMH relates to investment strategies. The theory supports passive investment approaches like index funds rather than active management. However, be careful with questions that present extreme scenarios. The exam might try to trick you with statements suggesting that EMH means all active management is useless or that market analysis has no value. Another crucial point for the exam is understanding how EMH connects with other investment theories. It forms the foundation for modern portfolio theory and the capital asset pricing model. Questions often link these concepts together, so make sure you understand their relationships. Let's talk about some specific exam pitfalls. Students frequently misinterpret questions about market anomalies. While certain patterns like the January effect or the small firm effect seem to contradict EMH, the exam usually wants you to recognize that these anomalies, once discovered, tend to disappear as traders attempt to exploit them. Remember that EMH doesn't claim markets are rational or that prices are always correct. It simply suggests that prices reflect available information so quickly that consistently beating the market is extremely difficult. This distinction often appears in tricky exam questions. When you see EMH-related questions on the exam, take a moment to consider whether the question is testing your understanding of market efficiency levels, the implications for investment strategy, or the relationship with other financial theories. This approach will help you avoid common mistakes and select the most accurate answer. Finally, make sure you can explain why EMH supports broad diversification and a long-term investment approach. These practical applications often appear in case study questions where you need to justify investment recommendations to clients.